Hi guys, welcome back to our channel Pixeled Apps. So today we'll be talking about a very interesting topic as to how money is created. Nowadays we see central banks printing money all over the world. So here's a question. We are told from a young age that money is hard to come by and that we should study and work our entire lives to earn it. So, how can all this money appear out of nowhere? How is money created? Who's going to pay it back? What exactly does all of this mean? And what's going to happen next? In this episode, we'll explore the three ways that how money has been created. At first, it may come to you as an easy job. You start up the machine and print the money. But let me guide you through the complexity of the level. The first type of money is created by the government in practice. It is outsourced to the central bank, Royal Mint, but it is controlled by the government. Physical money comes in two forms, paper money or coins. This physical money is a tiny fraction of the economy. In many economies, it accounts for only 3 to 8% of the total. It is created to meet the obligations of private banks. When you go to the ATM and try to withdraw cash, banks need to make sure that they have enough cash to meet those obligations. Since the government profits from printing and minting coins and can reduce taxation on the public, you may be wondering why government don't always print physical money. Do you know where the money is printed? What the place is called? The main reason that governments don't always print physical money is because of politicians. If the politician running the office could create money at will, there would be a massive conflict of interest because there would be an urge to keep printing to fulfill campaign promises or funds. The more money there is in circulation, the less it is worth, and this is a critical point. Let's suppose in such a situation, if you have $1 million, but those $1 million will be just enough to buy an apple. This is called inflation. And when inflation becomes out of control, money loses its value. Recent examples of runaway inflation include Argentina, Zimbabwe, and Venezuela. In this animation, you can see graphically how quickly can inflation run away. As the inflation rate rises, people lose faith in the currency. For example, in Venezuela, some people are using money to make handbags and draw pictures because it simply isn't worth anything anymore. You can think of money as a measuring stick of value that is highly elastic and can change depending on how much of it there is. For thousands of years, gold was the measuring stick. It was a physical anchor to keep the money supply in check and governments accountable in 1971. President Richard Nixon announced that the United States would go no longer convert dollars to gold at a fixed value. Since then, money has become elastic since the US backed all the currencies as a reserve currency. The vast majority of money created today is done by the private banking sector in most developed economies. Approximately 97% of the total money supply is created digitally by banks, and thus most money in the world is privatized. There are scenarios in which depositors try to withdraw all their money at once, but the banks do not have it. As a result of these events, banks argue that they should be legally allowed to create more deposits than actually exist based on debt, and this is how government outsourced the creation of digital money. According to Federal Reserve Court, there is now a 0% reserve requirement of all depository institutions and quote, so banks can now create infinite amount of money without no reserves. When banks hold your deposit, they, along with hedge funds, can gamble with it by investing in financial instruments such as derivatives and securities to earn superior returns. Most of the times, these instruments are basically just bets or whether the price of an asset will rise or fall, which taken to the extreme, it can get ridiculous. If they fall at risk, they are backed up by the government using the central bank to bail them out, and the money that goes and is raised in by taxation and trade by the government. A promissory note. a written promise to pay back the $20 you borrowed under the law. Today, we digitize this agreement and call it debt. This piece of paper, remembering that it's as good as money. Okay, so banks will authorize the use of these debt notes to circulate as money. From this point, banks were free to create and destroy debt. Let's look at how it works today. When you go to a bank to borrow money, the banking license gives that bank the ability to create money every time they issue a loan. They do this through the double accounting system. For example, if you buy a $500 house, the bank creates $500 in their account and you have $500 in debt. That is the promise to pay it back with interest. The $500 debt can enter the wider economic system because when you bought the house, the owner of that house could use the fresh debt created by the bank that they received from you to buy other things in the economy. This means that in our current system, if we want more growth, we need more debt. The critical point here is that debt is actually money. Just from a different perspective to the lender, it's an asset of money, but for the borrower, it's a liability of money. Pay attention to one thing here. The bank didn't have any money. It created new money and gave it to the borrower as debt. Now when he pays it back with interest, the new money created gets nullified, but the bank is still left with the money that came as interest. That's how they make profits. The bank's interest profit comes from real estate because banks have decided that it's the safest yet most profitable form of creating debt, because if you can repay the loan, the bank can simply take your house away. Now that brings us to the third and the last form of money creation, quantitative easing. When a central bank decides to use QE, it purchases financial assets like government and corporate bonds and even stocks. This relatively simple decision triggers powerful outcomes. The amount of money circulating in an economy increases, which helps lower long-term investment, and also this lowers the cost of borrowing, which spurs economic growth. By longing longer maturity securities, a central bank aims to lower longer-term market interest rate. Please don't forget to like, share and subscribe to our channel, to hit the bell icon, and don't forget to check out a book that's exclusively available on Amazon.